Hi, welcome to another video in the AS A-Level Managerial Accounting series. This is the third part of the standard costing. We've already done two videos on standard costing. So if you've not watched those videos, please watch the part 1 and part 2 and then come back to this video so that this chapter makes more sense. So in the first part, we covered the sales variance and under that the sales volume and the sales price variance. Then in the second part, we covered the material cost and labor cost variance and their subvariances. In this video, we are going to cover the variable overhead and the fixed overhead variances. So this is going to be the part 3 of the standard costing chapter. So let's start with the variable overheads variance. The calculation of the variable overhead variance, the overall variable overhead variance, is the same as that you did for material and labor cost. So our basic formula is the standard cost of production minus the actual cost. That will give us the variance. So here also the standard variable overheads for actual output, whatever is produced, for that whatever is the standard variable overheads based on management's estimates, that amount minus the actual overheads, that difference will give us the overall variable overheads variance. Okay. Before going ahead, let me revise a concept that you've studied earlier in AS level, which is called absorption of overheads. So what did we do when we were absorbing overheads? Before the year actually begins or before the period actually begins, the management budgets that this is going to be our overheads, this is going to be our output. So they calculate an overhead absorption rate in advance, which is equal to budgeted overheads divided by budgeted output. And what happens once the period is over, once the actual output is known, then we calculate how much is the absorbed overheads, how much overheads have been absorbed during the period, and the formula for that is actual output multiplied by overhead absorption rate. What do you mean by absorbed overheads? How much of the overheads we've been able to charge to our customers, because the moment you start selling your goods and in the selling price of the product, you've obviously included the overhead cost also. You've tried to recover that also from your customers. So the more output that you sell, more overheads you will absorb from your customers, and it is better for the business. So that is the meaning of absorbed overheads. You should be knowing this. I just revised it. If you're not aware of this concept, then you should go back to my videos on absorption costing in the managerial accounting playlist, and you can watch the videos there so that this concept gets better. Now, how do we calculate our standard variable overhead cost for actual output? We will take our overhead absorption rate per unit and multiply it with the actual output produced. That's how we will get our standard cost for actual output. So in other words, this is nothing but absorbed overheads. So in case of variable overhead variance, the standard cost of the output is nothing but the absorbed overheads itself. So just remember this fact. This absorbed overheads or the standard overhead, standard cost, will then be compared to the actual overheads, and that's how we will arrive at our overall variable overhead variance. If the actual overheads are higher than the absorbed overheads, it means you've spent more than what you've recovered from a customer. It will obviously be an adverse variance. But if the actual overheads are less than the absorbed overheads, we've spent less than what we've recovered from our customers, it will be a favorable variance. Now coming to the breakup of variable overhead variance, the variable overhead variance can be subdivided into two parts. The first is called the variable overhead expenditure variance, and the second is called variable overhead efficiency variance. Let's understand these concepts and also the formula for these variances. So if you read the name of the variance, variable overhead expenditure variance, what does it tell you? It tells you that we are trying to analyze when it comes to spending money on overheads. Could be any type of overhead. Let's say it could be electricity expense. When it comes to spending money, have we spent more money or have we spent less money than what the management expected? That is the meaning of expenditure variance. Giving you a quick example or an easy example to understand this. Let's say you budget that your rent is going to be 10,000 for the next year. But when you actually entered into the rental agreement, the rent turned out to be 12,000. So here you've spent more money than what you budgeted. This is a kind of an expenditure variance, but obviously rent is not a variable overhead. Rent is a fixed overhead. But the same logic you can apply here. When spending money, have you spent less, or have you saved money, or have you spent more than what the management expected? This is what we are trying to calculate under variable overhead expenditure. To understand the formula, you also have to understand one fact, that variable overheads vary with the level of activity. So the more activity takes place in the factory or in the organization, more will be the variable overheads. For example, if the labor keeps on working, then there will be higher power cost, higher electricity, higher fuel cost, because variable overheads vary with the level of activity. The more activity takes place, the more variable overheads, and because of the name itself, the overheads vary. They are variable overheads. So if I can take the difference between the standard overhead absorption rate per hour and the actual overhead absorption rate per hour, this will help me understand what the management expected the firm to pay per hour of activity and what the firm ended up actually paying per hour of activity. This difference will help you understand whether we've spent less or we've spent more per hour of activity. And that's how we can arrive at our variable overhead expenditure variance. But this difference will obviously be in dollars per hour. We need to multiply this with the actual hours worked during the period. Then we will arrive at our overall variable overhead expenditure variance. Then the second part is the variable overhead efficiency variance. As the name suggests, we are talking about the efficiency of the workers to produce the output. So how can we measure the efficiency of the workers? If we compare the standard hours that the workers should have taken to produce the output versus the actual hours taken by them, we will get an idea whether the labor or the workers were efficient or inefficient in production. So in my brackets, what I'm going to do is I'm going to say standard hours required for actual output minus actual hours taken by the workers. So it is very clear that this will tell us about the efficiency. But your question may be, how will it affect the variable overhead variance? I mean, why will the efficiency of the workers affect the variable overhead variance? It will affect the variance because variable overheads, as I told you, is completely dependent on the level of activity. Let's say the workers should be producing a unit of output in 2 hours, but they take 3 hours to produce 1 unit of output. So for that, every additional hour that they are taking for every output, every unit of output, the organization has to incur extra variable overheads. If they were fixed overheads, then the fixed overheads would not vary with the level of activity, but these are variable overheads. So if the labor is inefficient, obviously we will have to pay them more wage cost. That will be an extra cost for the organization, and that will be reflected in the labor cost variance. But it will also affect the variable overheads variance, because every extra hour worked will lead to higher variable overheads for the organization. That is the logic why efficiency of the workers is also affecting the variable overheads variance. Now this difference will be in hours. Standard hours minus actual hours, basically how much extra hours or how much less hours the labor have taken to produce the output. This will be multiplied by the standard overhead absorption rate per hour to arrive at the overall variable overhead efficiency variance. Now let's do an example to understand the variable overheads variance better. Budgeted data is given and actual data is given. For budgeted, we have out 300 units that were budgeted, and these 300 units should have been completed in 900 hours that was budgeted. And for these 300 units or for these 900 hours, our expected or budgeted variable overheads were $4,500. What we'll do is we'll calculate two things here. We'll calculate overhead absorption rate per hour also, And we'll also calculate overhead absorption rate per unit. We'll do this in advance so that if needed in our calculations later, it's easy. Overhead absorption rate per hour will be $4,500 divided by 900 hours. So $5 per hour. And overhead absorption rate per unit will be $4,500 divided by 300 units. So $15 per unit. If you haven't understood the calculation of this, just refer to the formula that overhead absorption rate is equal to budgeted overheads divided by budgeted output, or budgeted hours, depends what you're trying to calculate, overhead absorption rate per unit or per hour. I've used this formula to calculate these two numbers. Now going to the actual column, 400 units was actual output produced. These were produced in 1000 hours. Then actual overheads turned out to be $7,200. We need to calculate the variances. Like we did for material and labor cost, we will first have to figure out or calculate what is our standard cost or standard data. Then only we can calculate the variances. Remember, this is true for any cost variance. For our standard column, our output will be equal to the actual output produced, because we want to apply the management's expectations on the actual output. Now ask yourself, how many labor hours should have been taken to complete these 400 units? If we go by management standards, per unit should have taken 3 hours. So 900 divided by 3. Applying the same here, it should have been completed in overall 1200 hours. And how much should have been the variable overheads, standard variable overheads for this actual output, 400 units? So $15 per unit is the overhead absorption rate per unit. This is what the management expects the organization to produce the output in. This will be multiplied with 400 units. So $6,000. So $15 multiplied by 400 units. If you remember, I told you this standard overhead, it is nothing but absorbed overheads, because we multiplied overhead absorption rate by the actual output produced. So you can call it either standard overheads or you can call it absorbed overheads. So now let's calculate our variable overhead variance first, which is equal to the standard overheads or standard cost, also known as absorbed overheads, minus the actual overheads. Our absorbed overheads is $6,000, but the organization has actually incurred $7,200 in production of 400 units. It means $1,200 extra is spent, $1,200 extra is spent. So this becomes an adverse variance. Let's break it up. First, calculating the variable overhead expenditure variance. Some teachers or some books may also call this variable overhead spending variance. The meaning is the same. We are trying to calculate, while spending money, how much more or how much less has the organization spent. So if you remember the formula, the spending is dependent on the hours worked. So whatever is the differential between what the management expected us to pay per hour and what we've actually paid per hour, that will help us understand the spending pattern of the firm. So we will take a difference between standard overhead absorption rate per hour and actual overhead absorption rate per hour. This will be multiplied with the actual hours taken to produce the output. So standard overhead absorption rate per hour, we've already calculated here, $5. So $5 minus what is the actual overheads paid per hour. So we can do that, $7,200 divided by 1000 hours, $7.2 per hour. We'll be using that. So $7.2. This will be multiplied with 1000 hours, actual hours taken. So when you do the calculation, you'll get 2200 variance. Is this an adverse variance or a favorable variance? See, compare the standard overhead absorption rate per hour 5 and the actual overhead absorption rate per hour. It means the management thought that for every hour worked, the firm will spend just $5. But in reality, the firm ended up paying $7.2 for every hour they worked, which means extra money is being paid or spent. So the difference will be an adverse variance. And going to the second part of the variable overhead variance, which is the variable overhead efficiency variance. How do you calculate or how do you understand the efficiency of the workers? You see how much time they should have taken versus how much time they actually took. So I'm going to take the difference between standard hours for actual output and actual hours taken to do the job. This will be then multiplied with the standard overhead absorption rate per hour. So how much time they should have taken to do the job? We've already calculated 1200 hours. So 1200 minus actual time taken 1000. So minus 1000 multiplied by standard overhead absorption rate per hour is $5. So 200 into 5, we have $1000 variance. Is this favorable or adverse? See, actual time taken is less than the standard time that the management allowed. It means here the workers have helped the organization save 200 hours, and for every 200 hours that the organization saved, they saved $5 per hour in terms of money. Because had they worked these extra 200 hours, they would have ended up spending additional $5 per hour. So because of the efficiency of the workers, the organization has totally saved $1000. Hence this becomes a favorable variance. Now just compare 2200 adverse and 1000 favorable. That helps us to understand what is the reason for $1200 adverse variance when it comes to variable overhead variance. See, there's an alternate way of calculating the efficiency variance, which I will explain it here. You might need it in some questions when the details about the time taken is not clearly visible. So efficiency variance can also be calculated as the standard output that will be produced in actual hours versus how much was the actual output produced. Just understand, in the first method, what we did was we took the difference between the hours, like standard hours minus actual hours. But in the second one, we are doing the same thing, but in terms of output. Whatever actual time they've taken, in that actual time, how much output should have been produced based on what the management feels versus what is actually produced. This will then be multiplied with the standard overhead absorption rate, but per unit and not per hour. Because our brackets, the numbers in brackets are in units, the output is in units, so we'll have to multiply it with overhead absorption rate per unit. It's the same thing. It's a different way of saying the same thing, and we're talking here about the efficiency of the workers. So now let's calculate how much should be the standard output allowed in actual hours taken. If you see the data, as per the data, for every 900 hours, 300 units will be produced. So how much output should be produced in 1000 hours? Why 1000 hours? Because that is the actual time taken to complete the output. In these 1000 hours, how much output should be produced based on management's expectations? We can calculate that as and when we do the calculation, we get 333.33. So let's take it 333 units. This could have, or this should have been produced in 1000 hours. So let us write here 333 standard output. But what was the actual output produced by the workers? Clearly they produced 400, which is more than 333. This will be multiplied by $15 overhead absorption rate per unit. So 67 units into $15, we get $1005 favorable. Why? Because actual output produced is more than what the management allowed, or based on what the management expected, actual output produces much more. So $1,005 favorable will be the variance. This is coming to 1,005 because of the rounding of error that we did here. Otherwise the variance is same. So this is just an alternate way of calculating the variance, which I think you should be aware of. Otherwise you can use the first formula when you're doing your questions. So this completes our variable overhead variance. Maybe you find this more difficult than the labor cost and the material cost variance because this is a little more tricky. But if you watch the example once more or maybe twice, then your understanding will be better. And I will suggest you to have a proper understanding of this before going ahead with the fixed overhead variance. If you want, you can solve a question or two before going ahead with the fixed overhead variance, because the moment you start with fixed overhead variance and you're not clear with variable overhead variance, you will get confused between the two. Let's learn now how to do the calculations of fixed overheads variance. The overall fixed overheads variance will be calculated in the same way as we calculated the variable overheads variance, which is equal to the standard cost for actual output minus the actual cost. And if you remember, I briefly explained the concept of overhead absorption rate, which is then multiplied with the actual output. That's how you get the standard cost for actual output. So in this case also, our overall fixed overheads cost variance will be equal to the absorbed fixed overheads minus the actual fixed overheads. And how do you calculate the absorbed fixed overheads? It is equal to overhead absorption rate multiplied by actual output. And how do you calculate overhead absorption rate? Budgeted overheads, budgeted fixed overheads obviously, divided by budgeted output. This is done at the beginning of the year. Overhead absorption rate is calculated in advance, and then at the end of the year or end of the period, it is multiplied with the actual output. That's how we get the absorbed overheads. What do you mean by absorbed overheads? Absorbed overheads means during the year when output is produced and is sold to customers, how much of the overheads we've been able to collect back or recover from the customers, that is represented by overheads absorbed. Now, we will get either a favorable variance or an adverse variance. If the actual overheads are lower than the absorbed overheads, which means we've spent less and recovered more, it will be favorable. But if the actual overheads are higher than the absorbed overheads, obviously it will be an adverse variance. To understand what are the reasons for fixed overhead variance, we will have to calculate the subvariances. So first, we will have to divide the overall fixed overheads variance into fixed overhead spending or expenditure variance. You can also call it fixed overhead spending variance and fixed overhead volume variance. What is fixed overhead expenditure variance? See, same way like that we did in the variable overhead spending variance or variable overhead expenditure variance. This variance calculates that while spending money, how much more or how much less the organization has spent. In other words, when they were spending on overheads, were they able to get a good bargain, good deal for various expenses, or they ended up spending more in terms of money based on what management expected. Now in variable overheads, how we calculated the spending variance, we saw that these are the actual hours worked, and for these many actual hours worked as per management's expectation, there's a certain standard overhead cost per hour. So if we work a certain actual hours, based on management standards, our variable overhead should be a certain amount, and that we compare to the actual overheads. Why? Because variable overheads are dependent on the actual activity of the business. Higher actual hours worked or higher activity level, higher will be the variable overheads. So to calculate spending variance, we have to get our activity levels here in the formula in case of variable overheads. But fixed overheads are different. They operate differently because fixed overheads are expenses that you have to spend even if you do not work in the factory. Let's say the factory is shut down because of strike, still you'll have to pay the rent of the factory. So when calculating fixed overhead expenditure variance, we can't use the formula that we used for variable overhead expenditure because the way the expenses are paid are different. The formula for fixed overhead expenditure variance will be equal to simply the difference between budgeted overheads and the actual overheads. Why? Because management has estimated that the fixed overheads cost is going to be a certain amount, which is equal to the budgeted overheads, and this cost will have to be paid no matter how much you produce. Whether you produce a lot of production, you'll produce a lot of output, or you produce much less than what management estimated, the amount that you should be paying for fixed overhead should be equal to what the management estimated, and this cost will not vary with output. So this is compared directly to the actual overhead spent, so that you get how much more or how much less is spent. For example, if the management estimates that the rent of the factory should have been $100,000 throughout the year or for the year, and in reality we have paid $110,000, here we don't need to see how much is the output, how much is produced, how much is not produced, because this 100,000 rent will be paid no matter how much you produce. So it is directly compared with how much is the actual rent paid to arrive at the fixed overheads spending variance. Then we have the fixed overhead volume variance. Volume, clearly it means that the actual output, how much does it differ from the budgeted quantity, or how much the management expected the organization would produce. Why will volume affect the fixed overhead variance? Because when it comes to overheads, we have to absorb the overheads. Meaning, whatever we budget at the beginning of the period, we will be recovering it from the customers or absorbing it from the customers based on our actual activity level, based on our actual output. So the moment your volume falls, for example, based on the compared to the budgeted quantity, if your actual output is less, it means you've recovered less overheads during the period, and that will automatically affect your fixed overhead variance. So fixed overhead volume variance is also a part of the fixed overhead variance, or it is also affecting the overall fixed overhead variance. How do we calculate? Simply take the difference between the volume, which is equal to the budgeted quantity minus the actual quantity produced, and this will then be multiplied with the overhead absorption rate per unit. If the actual quantity is more than the budgeted quantity, what does it mean? It means more output was produced and more overheads were recovered from the customer. So it's a good thing for the organization, and in that case, the variance will be a favorable variance. But if the actual quantity turned out to be less than the budgeted quantity, it means the firm did not meet its target production and less overheads were absorbed from customers, more overheads were spent compared to what was absorbed, and in that case, the overhead variance will be an adverse variance. Now the fixed overhead volume variance can also be further broken down into two more subvariances, because when we say that the actual quantity is not as per the budgeted quantity, we have to understand the reasons why is it so. So the fixed overhead volume, we will further break it down into fixed overhead capacity variance and fixed overhead efficiency variance. Let's understand fixed overhead capacity variance. See, when a budget period is planned, the management knows that we have certain capacity with us. Let's say we talk about labor hours. We have X number of labor hours available with us. And how do we know that? They will count the number of workers that they have employed, multiply the daily working hours that each worker can work. So daily hours, and then multiply with the number of working days. What they will get is the budgeted hours during the period. So these many hours are available for work during the period, and output can be produced in these hours. This is called budgeted hours. So our capacity variance calculates or helps us to understand the difference between the budgeted hours and the actual hours worked. If the management has an estimate about the budgeted hours, the actual hours worked should be around the budgeted hours. If the actual hours worked is more than the budgeted hours, it is good for the factory, because more working hours means more output and it will contribute positively towards the fixed overhead volume variance. But if the actual hours is less than the budgeted hours, then it's an adverse variance. It will lead to an adverse variance because the management estimated certain working hours, but these working hours were not available actually in the factory. And the reason could be many. let's say there's a strike in the factory. So actual hours worked turned out to be less than the budgeted hours, and this will contribute in an adverse way to the fixed overhead volume variance. But the difference here, budgeted hours minus actual hours, this is obviously in hours. We will have to multiply this with the overhead absorption rate per hour. Then we will get our variance in dollars. So again, if the actual hours worked is higher than the budgeted hours, it will be a favorable variance. If the actual hours worked is less than the budgeted hours, it will be an adverse variance. Then fixed overhead efficiency variance is about the efficiency of the workers to produce the output in a certain time. So this can be calculated exactly the way we did it in variable overhead efficiency variance. We will compare the standard hours required for actual output, which is nothing but based on management's estimates, how much time should have been taken for the actual output produced. This will be compared to the actual hours taken by the workers. That will help us understand a rough idea about the efficiency of the workers. But this difference will be in hours. This will have to be multiplied with the overhead absorption rate per hour to arrive at the fixed overhead efficiency variance here. If the actual hours taken is higher, it will be an adverse variance. If the actual hours taken is less than the standard hours, then it will be a favorable variance. See, understand, we were earlier talking about fixed overhead volume variance, which speaks about the difference in quantity. Now, difference in quantity can happen due to two reasons. First, that working hours available were less in the factory and that's why less output was produced, which is capacity variance. Second, working hours were available, but workers were not efficient enough to use those working hours to produce enough quantity. That is explained by efficiency variance. That is why fixed overhead volume can also be divided into these two subvariances. So let's do an example here to understand fixed overhead variances. We have budgeted column and actual column. Under budgeted column, output was 300 units. Fixed overheads for these 300 units were budgeted at $8,100, and labor hours that should have been taken to complete these 300 units, it should have been 900 hours. Then in the actual column, we have 400 units actually produced. Actual overheads turned out to be $10,000, and the actual labor hours taken to do the job was 1,000 hours. As we always do, we will first calculate the standard data, without which it is not possible to calculate the variances. In our standard data, output will always be equal to the actual output. Now, also let's calculate our overhead absorption rate per unit and per hour. So if we take overhead absorption rate per unit, we have to take budgeted overheads 8,100, divide that by 300 units. So we get $27 per unit. And if we talk about the labor hours, overhead absorption rate per labor hour, $8,100 divided by 900 hours. So we get $9 per hour. Okay, now we'll calculate the standard data fixed overheads. So this is equal to the overhead absorption rate per unit multiplied by the actual production. So $27 multiplied by 400 units. So we have $10,800. You can call this as standard overheads or you can call it absorbed overheads. It means the same thing. Then labor hours taken or supposed to be taken for 400 units. So 900 hours for 300 units, that is 3 hours per unit. So 3 into 400, 1200 hours will be the standard hours required for this job. And also in the actual column, let's calculate the overhead absorption rate per unit, which is $10,000 divided by 400 units, $25 per unit. And for hours, it will be $10,000 divided by 1,000 hours, $10 per hour. Once we have all our data ready, we can now start calculating the variances. So the fixed overhead variance will be equal to absorbed overheads or standard overheads. You may write anything in the formula, that's okay, minus the actual overheads. So our standard overheads or absorbed overheads is 10,800. We've already calculated. So 10,800 minus actual overheads given in the data, $10,000. So there is an $800 variance. Now this is favorable or adverse. See, compare how much you've spent versus how much you've recovered from customers. You've spent less and you've recovered more from the customer. So it is good for the business. It will lead to higher profits. So 800 favorable variance. Now this can be further subdivided into fixed overhead expenditure variance and fixed overhead volume variance. Expenditure variance is simply the difference between budgeted overheads minus actual overheads. And I've already given you the reason why. So budgeted overheads were $8,100, which means that as per management's estimates, over the year or over the budget period, only $8,100 should have been spent. But in reality, the firm spent $10,000, which is more than what was budgeted. So $1,900 adverse variance. Then volume variance will be, or we will start the calculation by taking the difference between the volume. So budgeted quantity minus actual quantity, and this will then be multiplied with overhead absorption rate per unit. Budgeted quantity was 300 units, actual quantity was 400 units, and overhead absorption rate, the standard overhead absorption rate or the budgeted overhead absorption rate was $27, so multiplied by $27. So $2,700 is a variance. Adverse or favorable? See, actual quantity is more than budgeted quantity. When you produce more output in the factory, it is good for the factory. It will lead to higher profits. So automatically this becomes a favorable variance. So in case of fixed overhead variances, we also have to further subdivide the volume variance, because we need to study that if the fixed overhead volume variance is $2,700 favorable, what is the reason for that? How was the factory or how were the workers able to produce more output that led to this favorable variance? We need to understand the reasons for that, which will be because of two possible reasons. Either more capacity or less capacity, that will be calculated in the fixed overhead capacity variance, or because of difference in the efficiency of the workers, so that will be calculated under fixed overhead efficiency variance. Fixed overhead capacity, you have to compare what were the budgeted hours and the actual hours available with the organization, and this will then be multiplied with overhead absorption rate per hour. The management budgeted that they would have how many hours in the factory? 900 hours. So 900 minus 1000 hours actually available multiplied by $9. So that gives us $900 variance. Adverse or favorable? See, you have to understand whether actual hours are more than budgeted or no. So here actual hours are more than the budgeted hours, which means more hours or more working hours were available with the factory, with the workers, hence they were able to produce more output. So favorable variance. Now when it comes to efficiency, you have to compare the standard hours that are required for the job and the actual hours that were taken for the job, and this difference will then be multiplied with overhead absorption rate per hour. Okay, how much were the standard hours? We've already calculated here. If you see, 1200 hours and actual hours were 1000. So we'll take the difference between the two and then multiply this with $9. So 200 hours difference multiplied by $9, $1,800 variance. Adverse or favorable? Here it will be a favorable variance. Why? Because what the management expected the workers to take, the time the management expected workers to take was 1200 hours. But the workers actually finished it in 1000 hours. So it's good, right, for the organization. If the workers are showing better efficiency, it's good for the organization, and that's why this variance becomes a favorable variance. There may be a doubt with students that when you compare budgeted and actual, if actual is more, it is favorable. But when you compare standard and actual, if actual is more, it is an adverse variance. Yes, that is true. Because when you're comparing budgeted and actual hours, you are saying that how much working hours are available versus how much workers were actually able to work. In that case, actual hours should be more. But when you're comparing efficiency, you're comparing standard hours and actual hours, you're saying that workers should have taken this much time, but they actually took so much time. So here in this case, actual hours should be less than the standard hours, because here when actual hours are more than the standard hours, it speaks about inefficiency of the workers. So there is an important difference here, and you have to be very careful with this. So if you see, the 1800 variance that is favorable and 900 variance that is favorable leads to $2,700 favorable variance, and this $2,700 favorable variance and 1900 adverse leads to a net favorable variance of $800. That's our overall fixed overhead fixed overhead variance, overall fixed overhead variance. So I hope the variable overhead and the fixed overhead variances are now clear. You may have to watch this video maybe twice or thrice to understand the formula better, to understand the logic better. You cannot expect to just watch it once and just get it. So you may have to watch it again and again, and also simultaneously practice similar questions so that you learn the formula also at the same time, and I think it'll eventually be okay for you. So if you like the content, please like the video, please share the video with your friends, subscribe to the channel. There'll be another part to standard costing where I will explain the reconciliation. So make sure to watch that part. But before that, make sure you also watch part 1, 2 and 3, finish all these, and then go to part 4 of standard costing.